We like to gain, all the performers. They don't write much. We need to tell about them. No, I got only more lines from him. This is an example of a business savvy person. Kiran Korivi, a result-driven management professional with over 2 decades of experience in setting up businesses in the field of information technology and enabled services. His experience is directly relevant to all of you because he has gone through the journey of establishing the businesses and sustaining them. That is what is the most challenging thing for any entrepreneur. Sir, please come out.
Yeah, no problem. I'll stand there. So please.
In the fields of information technology, enabled services, foreign trade, and infrastructure. These are all his areas of expertise. Currently, he is a co-founder of Interview Buddy. You all heard about Interview Buddy. Yesterday, Mr. Ravi Israf was talking and narrating the story how the Interview Buddy came into existence. So, he is one of the co-founder in that startup company. They are doing very well, and the vision of that company is a grand. They have a grand vision. They always co-promote us. A Vizag-based edutech startup and Alcove partners. Alcove partners also you are aware. Deepak Srinivas they all spoke with all of you. Basically, they are investing in new ideas, brilliant ideas. Any one of you have got such kind of an ideas, worthy of investment by these angel investors, they are all ready with the cashbacks. It's up to us how we make use of the cash available for you to bootstrap or to scale up your ideas or to come out with a wonderful startup ideas. So the Alcova partners mentor startups by mobilizing financial, managerial, and other resources. Earlier, Mr. Kiran co-founded 24 by 7 service, BizServe, a F&A service provider whose business was taken over by Florida-based financial technology company. He is basically a serial entrepreneur. The definition of serial entrepreneur is that develop your idea, mature your idea, make the product, and start entering into the market and sell it to some big company. Then you come out with some new fresh idea again. That is how they co-founded Interview Buddy. So that is one of the typical characteristic of a technopreneur. Now, technopreneur is mind is full of new ideas. So one after the other, we would like to test it. Once it is tested, accepted, we will sell that idea to another big company and see for another new big idea and they work on that. So he's a perfect example of a serial entrepreneur and he was also part of the senior executive team as a director, regional operations, wherein he has implemented new business concepts, delivered innovative business solutions, and facilitated transition of business operations in a global service delivery mode for several prestigious clients. Kiran has done his MBA from Geetam and MCOM from Andhra University. I welcome Mr. Kiran to the podium and deliver his lecture. Let us give a big round of applause. Right. Please kindly try to inspire our participants because they are all youngsters and they should set their vision first. What is their goal in their life? Once you are able to inspire them and make them to think and set their vision, I think 50% of our job is done. So, through your example of your own life, how you become an entrepreneur, what made you, what are those figures, and what kind of challenges you have faced in your life, and how you have overcome that, and how you become a successful entrepreneur. So these lessons are very, very important for us to teach them. Okay, I request you to touch upon those factors as well. Yeah. we all know funding is the most important thing, no, to make your enterprise successful. So Mr. Kiran is going to speak on what are all the funding sources available, from government, private. The technology is engine for all the technopreneurs. You may say that you invented engine, but if you want to move that engine, if you want to drive that engine, what is required? Fuel. Without fuel, no engine can be driven. No? So that fuel is nothing but finance, particularly for startups and technopreneurs. So government of India has also been realized the importance of finance, and so many schemes have been launched. Some of the important schemes Kiran is going to explain to us, and also he will share some of his personal experiences.
Thank you, Professor, for your kind words and introduction. Good afternoon, gentlemen and ladies. Uh, it's indeed a happy moment for me to come and share my views on the entrepreneurial journey and also throw light upon the different funding sources available for this generation of entrepreneurs. When I talk about this generation of entrepreneurs, I'll also dwell upon the experience I had 25, 30 years ago when I wanted to do something on my own. To give you a brief background, as Purushottam Garu asked me to do, I hail from a business family, but my father was a consultant, he was an industrial consultant, management consultant, and working with great clients in India and overseas. And I moved to Vizag after I completed my 10th from Vijayawada and pursued my intermediate degree in Vizag and later on managed MBA in India. So from 10th onwards, my life has been rooted in Vizag. And like many people who have great words for Vizag, once you come and visit Vizag, Vizag attracts you. So though there have been many opportunities, an important part of me always said that this is the place where probably I will retire and do a lot of things. So while my father was busy in his consulting ventures, I was playing a second fiddle to him in all those projects. And I got associated in my father's business right from my 11th and 12th. And I am a big foodie, and this is version 2 of me. I weighed about 174 kgs just about 7, 8 years ago. So even in my 10th class, I was very chubby, and the first thing I woke up in the morning was to eat good biryani, and the last thing I had in the night was biryani. So that was my love for food, and my father rightfully started a restaurant business. And the instruction he gave to the chef was, I'm not much worried about whether you make profit or losses, but ensure that my both sons are happy. Serve them good food. I have another brother. So that's how my entrepreneur journey started under the guidance or protection or misguidance, whatever you can call it. Because my father always gave me the comfort of not worrying about money. But after graduation, when I was trying to play second fiddle to my father, I realized that probably I had more in me than to play a second fiddle because I was doing a lot of sundry jobs. If you can ask, my father was doing a lot of intellectual jobs, and I was doing a lot of errands, sort of a thing. If you can ask, at that point of time, we were into export of shrimp business. So I used to get up about, get up or probably sleep at about 4 o'clock or 5 o'clock, something like that, because I was going and procuring a lot of shrimp from the coastal belt of Andhra Pradesh. So my day used to start at 2 in the afternoon, wherein I had to go to the bank, draw money, which is cash, carry it in a car, go to all the ponds, make an offer, collect the shrimp into a procurement center, and then sort the shrimp, weigh it, pack it, and put it in a cargo terminal at the station. Primarily, we are operating from Vijayawada center. One night, something struck me in the middle of the night, 2 o'clock or 3 o'clock. I was like sitting in a procurement center with about a lot of people, and I was like carrying a lot of huge cash. Those days, there was not much of restriction. And then there were two people protecting the cash. and we used to make some purchase, 3 lakhs, 5 lakhs. The farmer used to come on a cycle. He used to put the cash in a gunny bag and put it on the back and go. And I used to sit there, give instructions to the people how to sort, how to peel, how to put ice and all that. And I said probably I could do more. By the time I also completed my MBA. And I said, let me start something on my own. And then I told my decision to my father. And that's when the father, like a true person, he said that, okay, that's a good decision, but I'm not there for your business. So that's when the trouble started, or the real entrepreneurial insights came into me, because I wanted to do a lot of things, but then finance was a constraint. And again, when you're playing second fiddle, you're not like having a lot of mastery in a lot of things. So you need to have a lot of people to help you to put the business together. So then I was fortunate enough to start some business, and more fortunate enough to fail in those business. And then we partnered with professional chartered accountants from Vizag. They were offering chartered accountancy, finance and accounting services to big corporates like ICICI Bank and all that. They were doing a lot of financial adjudication services. Like if you make a loan application with ICICI Bank, someone needs to verify the documents and say whether the loan can be approved or not. So they were doing that sort of services. Then something struck me. These people have the financial competency. So now the client is someone in India. Probably the same people offer these services to overseas clients. Instead of getting paid in rupees, probably I can get in dollars and I can make a huge margin. I was not even aware of the terms of BPO or ITES industry, whatever it is. This I'm telling in 1998, 2000. When BPO or ITES, KPO, these are all new things. And then what I did was, at that age, you have all the courage or foolishness not to think beyond. But one important ingredient every entrepreneur need to have is passion. You need to have passion and self-belief. So I convinced my friends in Vizag, the chartered accountant, said that you need not invest anything. You just give me a dump of whatever services you are doing. And I designed a brochure, a website, took a flight to US. Because my friend was there in the US, who completed his master's and PhD. By the way, if you have heard of Deepak Madala, he's my friend whom I have. He was here. He was another. Yeah, he did his PhD there, and I never went outside India till that point of time. My only idea to go there was because Deepak will be there and he'll be helping putting the piece together. But like another true friend, who will always say good things to make you really unleash your true potential and give hand when needed. So he said, take a flight. When I took the flight, he took a return flight and came back to India. So I was there for about 3 to 4 months, and then we tried to market through connects, and then made some presentations, learned a lot of lessons, and then got a pilot project and came here. And then we had to set up a service center in Vizag. No money. Who can we go? And the chartered accountants most, I don't know if you have experience of working with them, they are by nature very conservative. They don't want to invest. They took chartered accountancy profession because they are knowledgeable people. They build for their time. They don't want to invest their money. But again, we had to do something and raise some small funds and then quote a company, and then one by one triggered. And we built that company. We were the first finance and accounting service provider in Vizag, doing a lot of tax processing for US and UK and Australian clients, and all from people in and around Vizag, mostly from Chicago. So we broke a lot of barriers in our journey to build this company, and then we got acquired in 2005, and I was part of the company till 2011, and then I encashed when there was a second level of acquisition of the company, and then started another IT company, built a product, sold it, and now we are in the part of Alcove Partners, where we are now committed to encourage entrepreneurs, especially from Andhra region, because there is not enough support in terms of mentoring and funding and guidance for the startups. And we are very proud to be associated with a young person from Andhra University again, sir, Ujjwal Surampati. He is Andhra University mechanical engineer. He came up with this idea of interview buddy. We liked his passion and his idea. and then we started mentoring him, and we took his idea to forward. The company has got very good accolades these days for the continuous perseverance of Ujjwal. And recently, Interview Buddy was selected as one of the upcoming unicorns of this company in India. We are in the top 30 in India level. So that's how it is. But one of the things that I wanted to share is 20, 25 years ago, finance was a constraint. But today it is completely different. I'm talking about license Raj, where everything you needed a license, and then for finance you have to be either wealthy, or if you go to a bank, they would ask for a collateral security. So, and when you are getting into a service business, most of your expenses in the initial stages are for people, are for salaries. So there is no collateral that you can offer, because an idea for development, let's take a product development in IT, there is some man hours that needs to be invested in. And what you get is an intangible asset. The intangible asset, if it clicks, is an asset, otherwise it is of zero value. So no banker used to come forward to fund these activities. But thankfully, now the current generation of entrepreneurs are blessed to have an excellent and emerging entrepreneurial ecosystem where there are a lot of players to help and hold entrepreneurs at every stage of their entrepreneurial journey. And today I would like to share with all of you uh, uh, my knowledge and my understanding about what are the different avenues that are available for entrepreneurs these days. And also, very importantly, some of the decisions that you have to start thinking if you have a good idea is how to structure your company, when to approach for funding, whom to approach for funding. So these are some of the things that I would like to share today based on my experience, of course. Some of this may have got updated over the recent times, and there may be more professionals who have in-depth knowledge, because the change is not only constant now, but I would throw upon different areas that you can look forward for funding. So first of all, when you're talking about an entrepreneur journey, there is a lot of parallels or confusion as regard to what is a startup, what is a MSME. Are startup and MSME same? These are some of the distinctions that probably it's good to know. As today's session is probably more focused on MSMEs, because the government has really identified MSMEs as an important growth engine for the country, because 30 to 35, 40% of the country's economy can be driven by MSMEs. And the government has really focused on it and put together a lot of schemes to help MSMEs to grow. And more importantly, India being a most populous country, the real economy thrives only when more people get jobs. So MSMEs are also uh, job providers for the nation at a large level. Though they may be small and tiny units, but if you put them in a nutshell, they provide more jobs. So to provide jobs and to also drive the economy, MSMEs is the focus area of the government. So in this slide, what I try to share with you is the difference between what an MSME is and what a startup is. And this is probably more important because government of India is driving schemes for MSMEs and also for startups. So what is the distinction of both MSME and a startup is something that I wanted to share first. So the first and foremost difference is the business model. If you look at the business model of an MSME, any business model is okay for MSME. It could be starting a manufacturing unit, it could be starting a service unit, it could be a hotel, it could be a hospitality or anything sort of a thing. Everything is a bigger umbrella, and that can fall under an MSME. But when we talk about startups, startups are primarily based on innovation, and they are focused at wealth maximization or employee maximization. So startup growth is relevantly pitched on an innovation. So any idea that is new and it is not implemented so far, And with the implementation of this idea, there is enormous potential of business growth across the global regions, across markets, then ideally that is called a startup. So innovation is a key differentiation in terms of business model when you compare with startup and an MSME. And then in order to be classified as an MSME or classified as startup, there are certain criteria. For MSME, the eligibility is based on the investment and the turnover. It is a combination of how much you invest and how much turnover you make. Whereas a startup, it is only based on turnover. When I'm talking about startup, I'm talking about the definition of startups as per the government of India. Because a lot of schemes are based on these two criteria. So for startups, they say any enterprise, any new enterprise that is within 100 crores of turnover is termed as startups. And how is this turnover calculated? For MSMEs, it is gross turnover minus export turnover. So, which is net turnover based on sales in India is what MSME takes considers for classification as MSME. And whereas startups, it is gross turnover, it is total turnover. Because they believe startups have more markets across the globe, so not limiting it will be more beneficial. And how long can you claim yourself to be an MSME or startup? And for MSME, you can claim as long as you fulfill that criteria. But for startups, it will be only from the 10 years from the date of incorporation. And where you need to register for an MSME, you need to register with Udayam in the Udayam portal. And for startups, you need to register with DPIIT. These are both the central government. And what is the company structure you need to have for an MSME and a startup? For MSME, it could be any structure, whereas you can become a proprietor, you can be a partner, you can be a private limited LLP sort of a thing. But for as a startup to be qualified under the government of India, you cannot be under a proprietor. You have to have a legal entity which is a partnership, LLP or a private limited or a public limited company. And what are the governing provisions? The governing provisions are based on the circular that is noted on, issued on MSME 26 June 2020. And for startups, it is a note that has been issued on the DPIT 2019. So whatever I am saying, this classification holds good as of now. If there are any amendments subsequently, then the definition of this will change. We can expect that because it is an evolving process. Ownership restructuring, I don't know whether it is very relevant to all the people here, but this is for the next stage. For already companies who are having certain turnovers, if they want to split that company and hive off as a separate business unit, then it is called as ownership restructuring. For MSME, suppose there is a Reliance Industries as a company. So Reliance want to hive off, say it's telecom. Just take an example, telecom sector as a separate company. Because as a group, they have crossed the MSME turnover limits. But they want to take advantage of MSME scheme. So they can move all the telecom sector into a new company. And if that company falls under the turnover and the investment criteria, they can claim the benefits of MSME. So that restructuring ownership provision is available in MSME sector, whereas for startups it is not there. So you cannot break a startup into a further company and then continue to claim the incentives that you get for startups. And there is a tax holiday too, depending on the company that you own. There are no tax holidays for MSMEs as of now. But for startups, there is a section in income tax which provides you certain tax benefits or a tax holidays for a startup if it is registered with DPIIT. And there is another important provision which is called as capital gains exemption. I don't know whether how many people are well versed with this capital gains. No, this is a major move that has been taken by the government to give benefit for investment in startups. Yeah, this came back about 2 years ago, I think. So suppose you are having a home and you are selling it, you can only reinvest in another home in order to get a tax holiday for capital gains. But they have also considered you investing in a startup and you can claim a capital gains exemption provided you are the majority shareholder or the startup is started by you. So the government is looking at several means of giving some incentives, some hand holding to people to take the entrepreneurial path. So this I think distinction is something very important for you to really understand. And when you have an idea, you also need to think through how you want to classify yourself. Whether your business is based on innovation, will it come under the startup block or will it go under an MSME block? And then take a call. Probably as the journey grows, one can plan probably to start as a startup and then decide to get registered with MSME. Or you can be both. You can register yourself as a startup and also be an MSME to get the dual advantage, provided you comply with all the conditions that are required. Now, I mentioned about the distinction on MSME based on the investment and turnover. MSME is also divided into three segments: micro, small, and medium. So, what is micro? Micro is something where the investment is not more than a crore and turnover is not more than 5 crores. And small is something where the investment in plant and machinery is not more than 10 crores and annual turnover is not more than 50 crores. And medium, the investment is 50 crores, not more than that, and the annual turnover is not more than 250 crores. So we have four distinctions. Like one is a startup, MSME, and in MSME you have small, medium, and micro enterprises based on this criteria. So any incentives, if you are looking for really incentives, what are these incentives? These incentives are nothing like a pat on our back, saying that okay guys, you have taken a path which is not taken by many. So the government is there like a big brother to help you to take this path, which might give you a little comfort to probably take your idea further more days. When you are in crisis, you can use these incentives to help refuel it, to take that extra mile. So it is always very important to identify and know what are the different incentives that are available. But on the hindsight, you should not be starting an enterprise just because you are having some incentives or some rebates going on. That's not the right way. Because what you are stating very importantly is your credibility. It's okay to fail, but you fail for the right reason, not for the loss of credibility, because that is going to have a cascading effect on your entrepreneurial journey and your personal journey. So, having shared with you the difference between the different types of organizations, now I would like to share with you the different options, funding options that are available to entrepreneurs. So, there are primarily three types of funds that are available. One is called a grant, the second is called a debt, and the third is called an equity. So, what is grant? Grant is something that is most preferred by the people because it comes at a zero cost. You need not repay it, there is no interest cost to it, and by taking a grant, no one is going to uh, question you or be a part of your management decisions. They give you a grant and leave it there. There is less interference in the way you want to run the business. It's like more of a recognition sort of a thing, or you can call it a donation. More like a recognition, because grants are only given if you meet certain criteria, which is based on certain achievements. Okay. And the second part is debt. What is debt? Debt is normally what we call as loan, right? Debt comes at a cost. The cost can be fixed. If you go to a bank, he may say that okay, I need about 10 crores of loan. He may say that my interest rate is 10% annually. If you pay EMIs, and there is an EMI part of it where the bank will collect interest plus principal on a monthly basis. So there will be a schedule of repayments which you have to adhere to. And banks normally, as long as whenever you are taking a debt, the person who is a lender will not interfere in your business. So you still have good control. The control you have by taking a grant and the control you have by taking a debt is similar until and unless you make timely payments or adhere to the commitments. If you are not, then the people will come and they'll do a debt restructuring and probably put someone on your management. They'll try to take control of a lot of things. So that is the difference between a grant and a debt. And what about equity? Equity is you're parting away your ownership to someone else for a price. Yeah, you're inviting investors. You're not only seeking capital from them, but you're also giving him a right to ask questions, to take decisions, to be part of the management. It could be day to day, it could be board meeting, it could be strategic decisions. It all depends on how much of equity he owns. So, more if you want to give away equity, then you need to be really open to losing control and working in partnership with the other investors. So this is a major difference. So what the investor will get in a grant, someone giving a grant will not get anything in return. He's probably giving you money and forgetting that. So there is no commitments to the person. But for a person who is giving a check, there will be a term sheet which will list down the terms of the debt, and he is expecting a return on his money that he has lent to you. And for an equity, he will still have a term sheet sort of a thing, but he will wait for you to make money. He will only get return in the form of dividends once the company makes profits, or he can sell his equity to someone else if there is a prospective buyer, and the difference in his investment price and his sale price would be the wealth that he would get. So the returns the equity lender is looking at is high returns. So it is not a committed return because he is also risking his money. If he loses the money, because he is not only sharing profits, he is also sharing losses equally like you. So because he has got more risk on his table, he will expect more returns. So these are the three sets of people who are available, or the sets of instruments that are available for any entrepreneur to raise funds, which is grant, debt, and equity. Now, the question is whom to approach. As I was mentioning here earlier, if you want full equity and control within yourself, ideally you should be approaching government grants and funds or taking debts. From whom? It could be from banks, it could be venture debt funds or revenue based financing. Because you're not losing away your equity and you will have complete control in management. If that's what your end goal is, then probably you need to look at debt instrument or grants and funds. But if you are okay losing equity and control partially, then there are certain set of instruments that you should be looking at. This is called crowdfunding, accelerators and incubators, family offices, angel investors. I'll be sharing about what these categories of investors are in the subsequent slides. But this is where you formally look into if you are okay to lose a bit of your control. Normally, what is the control factor that is key in a company? If you the professionals who give you a lot of insights into the company structurings are company secretaries and chartered accountants. So if you ask them what is the level of investment that gives control to a company, to an individual, they will tell about two figures. One they say 51% and they'll get 26%. So they'll say these figures because depending on the structure or who are the investors. So if you want to have control, extreme control, then ideally you should have 51%. You can part away with 49% because 49% will have limited opportunities to take control of the management because you have majority of the investors in your hands. But again, there are some decisions which you cannot take without their consultations if you have 50, 51 and 49%. But these are some things that are, I'm just throwing you some pointers so that when you have a situation like that, you are very much aware of these factors that you need to think of. And then if you are only looking for, you are okay making, losing equity and control, but you want more money. This is what happens when you need more money coming in because you are not at a demanding side. You need more money, and the other person who is investing make demands. So he will say, okay, I need 51% of equity, and probably I need 70% of the board seat. He'll come up with some things for the money that he wants to give. So at that point of time, you may look at venture capitalists or other people who come in and then invest in this company to take it to grow. But again, one point I would like to make is losing control or sharing equity is not a bad thing. These days, a lot of startups have achieved the peaks because they invested not just because they need money, but with equity comes a lot of market connections, lot of management expertise, because it is not easy to run a company at different stages. When you start a company, you require a different sort of an attitude, a different sort of a skill to run the company from a bootstrapping stage to a certain stage. But once you are at a stage where you have consolidated things and you want to take it to the next level, you are competing with the big wigs who have deep pockets. So at that point of time, your advertisement budgets need to be more, your innovation budgets need to be more, and then your technology and management expertise need to be on the very higher side. So with parting away equity comes up this marriage of expert gaining and knowledge gaining and market connections gaining. So losing control need not be taken as a silver. It could be a welcome thing also in the entrepreneurial journey. And as I was mentioning earlier, these are the different stages of an entrepreneur journey.
What is the due diligence? Due diligence by the entrepreneur or by the investor?
Their past history, where they have invested, what are they bringing to the table. Absolutely. It's like a matchmaking. Ideally, matchmaking. It's not just the bride who takes the dish or the groom that takes the dish. Yeah. You need to look at the investor CIBIL score or whatever it is, their success area, their past track record. Right. Definitely. There are a lot of agencies who do the due diligence, whose business is just to do due diligence. So you can engage the business, you can engage the services of those people to evaluate their credibility and creditworthiness. Both parts of work. Yeah.
I know. Because I have to interject.
For the good of the audience.
Oh yeah. Because I take the advantage of
Yes, yeah.
all friends here.
Yeah.
You're talking from a entrepreneur looking at an investor perspective, right?
It's ultimately the marriage should work. It's
Yeah.
both ways.
Both ways. I'm talking largely. People ask, what is it that you look in an investor? What the investor looks in an entrepreneur? That I'll tell you. That's you have tons of this thing. But usually, what the entrepreneur should look at the investor perspective. One is the past history, what you're talking of. Do they have a habit? Okay, one is invest, continue to further invest in further rounds, or they're short term and they exit after a certain point of time. When I'm looking like if you're talking about a startup that we both co-found, if you're talking interview buddy doctor. Now we are looking at an investor who is strategic in nature. We are ready to go down on the valuation if he is able to bring in more business to us, get us the connected international market. So it depends on your situation. It varies from a situation to situation. And second thing is again, when you're looking at from the middleman perspective, usually we as an incubation center, when we mentor, we try and do the matchmaking. We become that
Exactly.
the person, and between when we say what are your needs from the startup perspective, so that we ensure that the person is not diluting too much. Like even when there is a government investment that happened with EduMoon, it's one of the startups, which is a student startup. They're into student company. Initially started with something else, then they went into, and then as part of what's that? Not Calcutta. There's SCBI has a NGS. In the NGS 2.2, they were shortlisted. They were supposed to be funded around 20-25 lakhs. That's the maximum 25. So these people wanted 20 lakhs. They were Pontiac was their mediator between Mighty, which is the funding agency, Ministry of IT, and the startup. Pontiac is a UK-based consultant, financial consultant, who was doing that. So they asked for 25%. I chipped in on these guys as a mentor from Hub, and I said, not 5%. He said we started with 2% and finally landed at 6.6% for the same amount of money. So you have to see how much you're diluting. I said if it's more than that, we don't need it. Suddenly we said we don't need it. It's too much of a percentage, but too less amount. He said thank you. Then they again negotiated and we arrived at our stage. Now from an investor to an entrepreneur sort of a thing, or a co-founders, people that who run it. So there are multiple things that they do. One is just people, the co-founding team, the team that you have. Two is it just like a merger and acquisition or any M&A that you do. The same checklist will also in a due diligence, whether it is operations perspective, sales, your projections, your compliances, legal and I'm sorry, regulatory, statutory related compliances that you're trying to do, and then are you compliant with everything, right from ESC, BF, and other stuff, or there is something that you're doing which is like in one of the they were talking a lot of they're putting a lot of money into cash. People would not like to go with such companies. So they also do have their own due diligence with respect to, and then your past history and all that stuff, your financial standing, your past history, all that is taken into that. So it's a both side. There are two people are trying to do the matchmaking, but there are a lot of mediators. It's just like the parents on both the sides trying to ensure that happens or doesn't happen. Sometimes it's not just the will and wish of the bride and the bridegroom, but it's also the parents who take away their influences in the whole. Thanks.
Thank you. So, as I was telling about the different stages in a business, I just wanted to throw light on the most categorized stages in a business. The first stage is called as an ideation or a pre-seed stage. This is when someone will be really brainstorming about what you want to do. You have an idea in mind. So you want to build a prototype sort of a thing. You want to do some market survey. You need to do some market survey on the competitors or consumer behavior sort of a thing. So this is when the idea really gets its first birth. So that's called the ideation or a pre-seed stage. And then this idea gets validated in the second stage, where you build a prototype and then take it to the market. You go with a certain set of assumptions, and then once you go into the market, it may be a hit, it may not be a hit. So based on the feedback you get from the market, you make some tweaks to your idea or a product, and then relaunch it. And the next stage is called the early traction, which is once you have the product or the service ready, you get your first set of customers. Okay, the first 1 lakh or first 100 lakhs or whatever it is. That is where you are getting customers from different verticals that you are choosing. These are called the early traction. And then once you got the early traction, you build your processes, because the success of any startup is scale. The same level of service you have to probably offer it when you offer it to 10x or 100x customers. So how do you do it? And how do you get that scale? That is called as growth stage or scaling. And final stage would be an exit stage. Okay.
Okay. There. Just ask him.
So the final stage is called an exit stage, where the original set of investors or an entrepreneur would like to come out of the company, and he would like to maximize his wealth. That's called an exit stage. So there are different, but the reason why I put together this slide is to throw light upon whom to approach in different stages of your business. Okay. The first stage, which is called as an ideation or a pre-seed stage, this is when your idea is just in your mind, right? So no one is going to give you money based on the idea. They would like to see a product or some early customer sort of thing. So the trust level is normally not very high on you, or there is a lot of mistrust in our own capabilities. So normally what we do is we reach out to friends and families, because they at least want us to do well. They know us, or they have a lot of love and affection for us. So they are the first set of investors. And normally, and here, that is when the government is also coming to help really people with good thoughts and innovation, even in the pre-seed stage, which was not available earlier. That's where probably A Hub is there. It is trying to handhold you and say that, hey man, come, we are doing a hackathon or we are doing a startup competition. You come and present your ideas. If I like your idea, probably you can come and operate from my incubation center. I am giving you a seat free of cost, or I charge you just 3,000 rupees. You can work, and I am there. Ravi is there sitting and saying that, yeah, you can use my experience free of cost to guide you, help you to take your idea to the next stage. So that is when probably you need to approach bootstrapping or go to self-financing. You reach friends and family, and then you need to participate in business plans and pitching meetings. Very important. This is where you get the early traction. And then when your idea is out and you wanted to validate, then you go to incubators. A-Hub is one such wonderful initiative taken by Andhra University, and Ravi has been doing excellent job in incubating a lot of bright minds from this region. And I'm sure the next 2-3 years there will be many more successful ventures popping out of his office in Andhra University. And there are a lot of loan schemes that are available to help you in the validation stage. And there are also a few angel investors who would like to invest in your ideas or thoughts. And there is something else called as crowdfunding. What is it? We'll talk about later. And then once you get validated, then you are looking for early traction. In the early traction stage, that's when you need to approach venture capital funds or look at banks and NBFCs, because normally if you go to any banks or NBFCs, they ask whether you have a balance sheet. How much profit are you making? So all this will only happen after your, and they'll say probably 3 years balance sheet. Ideally, they'll ask for a 3 years balance sheet. So that is when you can really approach a bank in the early traction stage, but not initially stages. And then there are some venture debt funds. There is a distinction between a capital fund and a debt fund based on the type of the money that you want. If you want a debt, you need to go and approach a venture debt fund. If you want equity, you can go and approach a venture capital fund. If you want a loan from a public or from an institution, then you can approach banks. And when you are scaling, when you are really in a growth stage, you need to approach the venture capital funds. More importantly, as Ravi was mentioning, venture capital funds, who are they? If they are serial entrepreneurs who know the art of growing business from 3 to 30 in a shorter span of time, because they are very well connected, they can get you good reference, good clients, good volumes in the shortest period of time. Like for instance, if I know a venture capitalist sitting in New York, let me say for the sake of the company that we invested in interview, and there is a company, the venture capital guy already invested in a lot of edtech companies in the US. If he puts in some money in interview buddy, I know in the next 3 months, all the edtech companies he has invested will at least give us a pilot project.
And if you are successful, my revenue from X may go to 10x. If at least 20 or 30% will be converted. And my profitability can go from 0% or 10% now to 60% because it's an overseas client. So when in a growth stage, it's ideal that you look at people like venture capitalists, but they give you money, but they suck your blood. They will really put you on a high operating mode. You have to really run till you die. If you have to survive, you need to have high passion and you have to take a lot of steroids. The steroids can come from the igniting passion. Or else they will not hesitate to chuck you out because they are all interested in ROI for their investment. So, having given you an overview about the different stages and different types of instruments you need to look into, I would like to share the difference between angel investors and venture capitalists. A lot of people probably talk in synonyms, but there is a slight difference between angel investors and venture capitalists. What is the difference? Difference is basically in the structure. An angel investor can be an individual who made a lot of money, who had a lot of money, who wants to invest in companies, right? It may not be a corporate sector, or it could be a group of people who are trying to do that, like we in Alcove partners are trying to play the role of angel investors because we have a limit in terms of the amount that we want to invest. And we want to help more and more startups grow. So we want to get in at the early stage where the money is not available as of now. So we want to reach out to more companies with good ideas. So the intention of angel investors are completely different from that of venture capitalists. Having said that, no one is going to give this money for free of cost. They want a return. But again, the intention matters a lot. How much and how they want, how much of control they would give you to allow you to grow the business, this sort of thing. And what is the investment size? Normally, the investment size of an angel investor is anywhere between $25,000 to $100,000, whereas the venture capital funds it is about 7 million. It depends. It's just a ballpark figure that I'm showing. It is just to say that when you need small amount of money in the initial stages, probably you approach angel investors and not a venture capitalist one. And what are the responsibilities and motivations? This is what I talked earlier about the attitude of this venture capitalist or an angel investor. Angel investor is more looking at financial support and is willing to provide advice as an advisory role. And advice is something where the person who is giving an advice should not get offended if that advice is not being implemented. Right? That is the principle of an advisor as well. He should not, because the choice of the decision should always lie with the entrepreneur. Because the risk is this. Just because I gave an advice, you didn't take it, you should not stop yourself from giving the advice if he approaches again. Then you are not a true advisor at all. But whereas the venture capitalist, he will try to establish strategic focus. He will help you get the right talent, very important in a growth stage of a company. Because people who are high caliber would not like to risk their careers working for a startups. So they want to know whether the startup will be successful or not. Suppose tomorrow an interview body gets Ratan Tata as one investor, then probably a lot of big wigs can come and be a part of the management team or operations team because of Ratan Tata. Or else if we go and ask someone, say someone working in some company to come and work for us, he'll have his questions whether I'll get my salary next month or not, whether there is sufficient growth or not. So getting the right talent is one of the important takeaways besides equity when you partner with it. And then sounding board for CEO. This is an important aspect. You see, as a CEO of a business, there are a lot of times in the decision making process, you need a lot of input, support, and someone who needs to hear you totally and say good and bad or something. So that is very important, and that's what you can do with VCs. What they do is they structure meetings, quarterly meetings. They'll ask for reports. So through reports, they will read the growth of the company and they'll identify this is an area where you need to focus. This is what is not doing well, so on and so forth. And as I was mentioning, what are the different stages of funding you need to look for? Angel investors, it is early stage business.
or late stage technology development or early market entry. And for VCs, early stage companies and more developed companies. When you're really going for a growth phase, then you look at VCs. And due diligence, as my friend was asking earlier, the due diligence by an angel investor is relatively less when compared to that of a VC. VC due diligence is very exhaustive. They would ask for so much information of your company, balance sheets, and a lot of things. And to get to a stage where they really invest their time itself, it takes a lot of effort. So it is very exhausting. And again, the point why I'm highlighting here the need of due diligence is if you want to approach angel investors and VCs, you have to be aware of this coming right at the day one. You need to be proper in terms of taking all the licenses because compliance is a big thing that any investor looks into. Whether you have all appropriate licenses, are you compliant with all local laws or not? Very important. And like Madam was saying, intellectual property rights. That is very important. For an idea, the first thing they ask is, okay, have you got a trademark? Have you got IP rights? So normally people do not look at it as a major step, but if you want to take a path of approaching an angel investor on a VC, they want to be very sure is this idea protected or not. So right in this initial stage, that's when you need to plan, okay, my idea needs to be patented, my idea needs to have a trademark, or I need to get intellectual property. And that is the reason a lot of government schemes are aimed at this. If they say that, okay, we will reimburse the cost of trademarks, licenses, and patents as a first step, because no one would like to pay that much of money in the initial stages of work. But the government says, okay, you spend that money and we will reimburse it if you get a patent, if you get a license or something like that. So when to reach an angel investor and who these angel investors are? These investors have surplus cash that they are willing to risk in your venture at the seed stage. They are looking for the initial stages. And normally where they meet this entrepreneurs is they come in the pitching competitions. Ravi says schools because we all belong to the same group. We eagerly look for an idea that is going to succeed. And we invested a lot of time in going to colleges, talking about them, hearing a lot of pitches, and hearing crazy valuations. People say, this is my idea, and I'll give you 5% of it, provided you give me 50 crores. Then for what? They say, unique idea. What is unique? There is no uniqueness. So we have to hear through this. But again, because based on the questions we ask, they will at least next time when they're going to the next pitch, they'll start thinking, okay, it will help them prepare well. And they act as mentors. And again, the proof is probably Ravi has more validations to come through because he has been a genuine mentor for a lot of startups. But that's what angels are supposed to do. And they invest either in the form of an equity or a debt. And there are a lot of angel platforms that are available in India as of now. Earlier, this was not there for Indian entrepreneurs, but for the past 5 to 7 years, more and more people are getting onto the angel platforms. If you Google and look for angel startup platforms, there will be many. Angels. Yeah, angels is another recently started. Ravi is also a part of it. So more and more people are looking at this as a wealth creation opportunity. You see? So this is like when I talked about the entrepreneur ecosystem, it's important that we have this element of angel investors. And earlier, the angel investors were from outside. So they didn't probably know how business are conducted in India. But now there are angel investors in India, in Vizag. Like for us, someone is coming with an idea in Vizag. I know how Vizag people behave. I know what works in compliance, what works, because I have more experience than the person who is having a different experience at a different level. So having people at multi levels available is a real boon for Indian startup system. And then who are venture capital funds? These are the people you need to look for when you're really in an acceleration stage or a growth stage. And they provide large amounts of of capital to really go from X to 10X. Okay, they bring in people, they bring in the right solutions, they provide great market access, all this as a fraction of time, which is much, much lesser than what you normally have to do. And they ask for a return for their investment. And what do they want? They want equity or equity linked investments. This is something that you probably will come to know as you progress. Because a part of it they may give you as a debt and which may get converted into an equity at a later stage, so on and so forth. So there's a different restructuring happening in the investment arena to protect the investor's point of view. And similarly, the startup entrepreneurs also need to be aware of this nuances. And how do they make money? What the venture capital funds do is they sell this company to a different company and make money, or they take this company to an IPO and then they diversify or divest their equity. That's how they make money. But if you have noticed in the lot of businesses that got VC funding in India, very few of them are making cash profits. They have hefty losses on their balance sheet. But again, their valuations is very high. They're still attracting a lot of investments because of the different business models that they have adopted. Okay, so it calls for an intelligent investors to really foresee the potential of the company and also to explore the opportunities that are available beyond the original idea of the business. Okay, so that's something that the VCs and the angel investors would look into, the synergy point of view. And again, there are a lot of active VC funds in India. You just Google it, there will be a plethora of companies that are offering at different levels. And now, as I mentioned to you about the different stages of a company, this is an important aspect that I wanted to share with you. In the idea stage, 100% here I mean is the 100% control you have as a promoter of a company. Okay, because what is idea stage? We talked about it. Your probably value, company value is zero. There's nothing. It is just an idea. So the founder's equity is also zero. There's nothing there. The second stage where probably you'll get a co-founder. If you're not having a team of people with the idea, probably you'll get a second level of person to be a co-founder. So that is when you part away with equity. So then your 100% will get diluted depending on how much percentage you part. 40%, 60%, 25, 75, 90, 100, whatever it is. So, and then if the company valuation is $2,000, then probably the founder, assuming that he holds 60% of the equity, his value will be just $100. But it is much more than the ideation stage where we get 100% equity, where his value is zero. Because how do you value something if there is a buyer, right? So here there is someone who is willing to take an equity. And then the seed funding stage, you part away with much bigger chunk of equity. And then there will be family and friends or incubators of someone company. And then the company valuation might go to 50,000. And the equity holder may still be having 30%, but his equity, the founder may be valued at $50,000. And Series A, B, C, D, this is where it happens when VC step in because you do need funds not in one shot. So the first investment is called as Series A, next B, C, D, and that's when the equity gets valued. And this is where they exit, they sell it to someone else, the company valuation goes. And that's how the company's wealth is maximized, and so is the promoters and the investors. So if you see here, in this case, probably the founder's equity has grown to $75,000. So by parting away with equity strategically, both the founder and also the equity participant is also getting benefited for a successful idea. If it's not a successful idea, probably it will get shelved at an idea stage or a co-founder stage or whatever it is. If it is seeing the traction, then probably it is the win for all the people. And then the final stage, which is called the mother of all exits, is called an IPO stage. Because there will be a lot of people participating in a public or public offering. And then equity gets diluted. So these are the different stages of funding and these are the different people whom you need to approach.
Now, the another set of people whom you can look into is accelerators and incubators. And as I was mentioning here, we are fortunate that we have two accelerators or incubators in Vizag. Or Ethan also has one, right?
Vizag?
In Vizag.
Six.
Six? Okay, that's useful. So, what are those?
MTZ,
Okay.
APIS,
Okay.
Etham. IMB, IMB, and there's Gayatri, yeah, Gayatri have it. So then all the education institutions have it, but these are considerable.
Excellent, excellent. You see, this ecosystem is going because accelerators and incubators, these are most likely called as the prep schools for startups. So they prepare you, they will give you insights into how your journey is going to be. They will
STK.
Yeah, okay. Like Purushottam Garu is conducting this session, just to incubate the people, to give them overview of what are the different things people need to look into right from the startup stage or the ideation stage. And there are certain programs that are run by the accelerators and incubators where people can join the program, which is if you have an idea, you build a competition, and then they will take you into this incubator stage because there you can benefit from the mentors who are sitting in the incubators who will help you, guide you, and take your idea to the next level. And what are the takeaways for any entrepreneur who is going to an accelerator or incubator? He can have an options of funding, like he can have a lot of guidance. If there are any angel investors or VC coming to Vizag, probably accelerators and incubators are the first landing point. They'll ask them, hey, any good ideas in your company? So why don't I check out 3 hours of my time where your best people can present? That audience is very difficult to get. To get that time is very difficult. But if you are part of an accelerator or an incubator, it is easy. And then it's a platform to connect with investors, mentors, and startups. So this is an important attribute where you need to look once you have. And there is again a lot of information on the web about the best startup incubators and accelerators in India. And as we know from Ravi, there are 7 in Vizag. So depending on if you are in the college, that's the best time when you on your ideas, because you can get the benefit of a group working together. You can take the inputs from your faculty, and you have an age where it's okay to fail. Right? What else you would be doing? Probably going to arcade beach and spending time there or watching something on the internet. Instead of that, get some ideation experience, get some failure experience for a good reason. And then there are a lot of hand-holding that is done by the government. As I mentioned to you earlier, government has come up with programs specifically for MSMEs and also startups. They handhold both these companies depending on the stages they are, the sectors they are, and they also come up with a lot of investment options which are spread across the instruments that I said, which is a grant, a debt, or an equity. So the government has come up with a lot of schemes. I see the session tomorrow, sir, on MSMEs. An exhaustive session probably will give you much insights into what are the different avenues that are available for MSMEs in India by the government. I would like to give some insights into it. So there is a Startup India program that is going on, which is to encourage startups in India. So what they do is under this program, they give 80% rebate on startups on patent costs. Very importantly, because patents are very important for any startup idea. Because idea is very important, that has to be protected from anyone copying it or using it without rightfully rewarding the original inventor. So, for any money that is spent on patents, Startup India program provides you an 80% money back. And then it also gives you income tax exemption for any profits that you make.
100%.
It's 100%.
See, for the academic institutions, it's 80% rebate. Of course, if they file on their own the startup, they give 80% to them.
Okay.
Not okay, 80%, and there is also a scheme called SITP, through which you will get 100% also.
Excellent.
Some designated agencies have been identified by the government. If you
You need
file,
to validate.
yeah,
You need to validate. Yeah.
you file your application, no, you don't have to pay. The government will reimburse the patent agent.
Okay, they pay to them or they
Yeah,
reimburse?
no, they pay directly to the patent.
That is very helpful, right?
Only government fee has to be paid by the startup.
Okay.
Professional fee will be paid by under that particular scheme.
Okay. Probably. So if this 80% has gone to 100%, is all the more important. And then they get a tax exemption for 3 years for startups registered under this scheme. And there is a Startup India seed fund. This is done with the help of SIDBI, Small Industrial Development Bank of India. They've earmarked certain money to be given to startups because startups are not a priority sector lending for banks earlier. None of the banks were willing to give loans or invest in startups because it would reflect on their balance sheet in a negative way. So, NPAs. So now what they have done is they have created special engines or special funds which are targeted at that. So you can look at Startup India Seed Fund if you need fund and if you qualify. And there is another zone startup grants for business. This is another scheme that has been launched. All this information is available in the MSME portal under the funding options. And there is a lot of eligibility criteria, the sectors that are required, some of which I'll be sharing. But if you want detailed information, that is the go-to place if you want to register yourself as an MSME and look for grants. Okay. So under the zone startup funds, this is again a private fund which is run by Rights and Future Networks. It is an accelerator program. So applicants are not required to provide a formal business plan. This is something that struck my eyes because one of the basic things that we look in when we are going to any or talking to any entrepreneur is they do not have how to write a business plan. Honestly, I do not have an idea to write a good business plan even now after doing some businesses because you never went to an outside investor. If you go to a bank, he will give you a format. You go to a chartered accountant will fill in and do the thing for you. But if you're going to an angel investor or a venture capitalist fund, then the business plan is a very important thing. And making a business plan for a young guy is not easy. Okay, so this is where this company is doing something different. It says that they are not required a formal business plan. They'll give a grant budget in the range of 50 lakh to 3 crores. The preferred startups are AI, EdTech, and they have a list of priority tasks, priority sectors. If you fall under that umbrella, you have an innovation, then this is the go-to place for you. And there is something called as the Technopreneur Promotion Program, something aligned with the seminar that we are doing, the PRISM TEPP. This is again by the government's Department of Science and Technology. This is just to help innovations flourish in India. It's probably routed through a lot of colleges and academic educations. This program gives funds at several stages, starting from the conceptualization stage to the different stages of business. And the ticket average investment size ranges from as low as 2 lakhs to a crore. And there is something called as an unlimited Indian organization. This is a non-profit organization which is offering help to early stage, but the sector they have identified is social entrepreneurship. If your idea is going to help society at large, it's okay to make profit, but again, the objective of the idea is to make a difference to the society at large. Then they are going to invest or provide you a grant to take your innovation forward. And they are looking at early stage startups from 0 to 5 years. And the sectors they have identified for the innovation to flourish is agriculture, livelihood, education, environment, sports, so on and so forth. And these are the priority sectors because they're doing it not for making money, but they are doing it for a societal transformation. And then there is a big scheme which is called as the Biotechnology Ignition Grant Scheme. From the name itself, this is primarily focusing on innovations coming from the biotechnology sector. So this is the grants. You have to be incubated
or have a registered company with a functional R&D. So the research and development lab is a must. So that is where you need a lot of money in research. So if you have that as one of your goals and your idea is in support to that sort of an endeavor, then these people are the go-to people. There are also multiple layer grant for startups. This is from Electronic and Information Technology Department. And again, they would give a grant for about 2 years, up to 2 crores. This is again a sectoral thing. So they would be focusing on IT, analytics, enterprise software, or IoT sort of sectors. And then there is a NASCOM startup scheme. This is launched as early as 2013 because NASCOM has been the big brother that has really helped Indian companies get the recognition across the globe. So the big wigs of the IT industry have come together. This is not a government initiative, but the companies, software companies initiatives, wherein they do a lot of activities to encourage startups and then facilitate them to go to the next level. So the startups are paid with accelerators, which they connect you to different accelerators, and the members of successful companies act as mentors, and they will also help on the strategic alliances, which are very important for any company to grow from X to the next stage. And the sectors they are looking at is these sectors get redefined, probably aligning with the opportunities available in the market and also the vision of the country. And then they help from the industry's point of view to give that fillip to the budding entrepreneurs and play a very vital role in entrepreneur ecosystem. So this is another avenue that is available, which is called as crowdfunding. What is crowdfunding? You see, we talked about investors who are single but who have large chunks of money to invest in startups. They fall under the angel investor background. There are group of investors with sizable money, or they have access to sizable money because they approach different money market instruments to raise funds. They form under venture capitalists. But crowdfunding is for retail investors who want to invest in startups. So you and me, suppose I have 10,000 rupees, I am willing to take more risks. I don't want to invest in a bank FD or buy a piece of gold or do something, but I want to be a part of a startup, which is normally not available. So crowdfunding platforms provide this opportunity for investors and also the seekers of money. What they do is they integrate. So suppose I have a requirement of 1 crore, I put my business idea into this crowdfunding platform and I give a ticket size. I say that okay, I am willing to accept 50 people with so much ticket size to raise this. So anyone can willing to invest say 50,000 or something can be part of my research. This is an important avenue available. I am not really sure about the legality point of it because SEBI has an important role whenever you are raising money outside your group. So this is something that needs to be validated, but there are platforms available on the Indian market. And I see a lot of people sending me requests with these ideas. So these crowdfunding platforms are available wherein you can put forward your business idea. And the beauty of crowdfunding is because these are all small ticket investments, like assuming that I have to raise 1 crore and I don't want to be answerable. Instead of borrowing 1 crore from one person, I am okay borrowing 1 lakh from 100 people because it is just 1 lakh people may ignore. So that sort of mentality. So whoever is putting small chunks of money will not ask a lot of questions. And when they know that they are investing in startups, they know that there is risk involved. So it is good for a startup when his confidence level is also not much, or probably he doesn't have the capability to manage investors. Manage investors is not an easy thing. So probably he can look at this sort of platforms. And this is another important avenue that has emerged even in the Indian market, which is called as a family offices. What are these family offices? India's business ecosystem is more traditionally has been a family-run business system. You have Tatas, you have Birlas, you have Ambanis, now you have Adanis, and there are pyramid groups, this group, that group, that group. So all these people have made tons of money. So they are also wanting to be part of the startup ecosystem. So what they have done is they have divested or carved out this amount of money and started something called as a family office, which primarily invests in startups. So if you look at the right side, though it is small, you can look at Bharati, you can look at Suzuki, you can look at Adani's, lot of companies. Even GMR probably has a family office. So they are also encouraging. So if you have an idea, if you belong to this region, probably you have connections, you can easily connect to them. They come with a more amount of money at your disposal, plus all the benefits that you get from an angel investor or a venture capitalist. And some of the investment ideas they probably would like to get in is something that it is connected to their business, be it a backward integration or a forward integration. If it's assuming that there is some company which is into retailing and there is a lot of money that goes into packaging. So if you go with the packaging innovation idea, go and meet them, they say that okay, your first set of clients are me. I will give you this much of business. I am investing this money, but you supply me this. So you are at a more comfort level. So there are a lot of people like this in the family office that are available to you. And again, the list is available in the market. And there is also something called as a micro leases. Right? By definition itself, it's micro. So they're probably somewhere in between angel investor and a VC with a small ticket size. So these people can be approached in an idea startup stage. And their whole purpose is to help you to create that prototype. Idea is in mind, you need a prototype to be physically present. At that point of time, the micro VCs, because depending on the innovation, the budget may be high. So at this point of time, this is another avenue that is available for entrepreneurs. And what they normally look at is equity for the money that they give in. So there are a lot of players in this arena too. So these people can be approached. And depending on which sector you are and what are the criteria of these funds, probably you can pitch in your ideas to them. And we talked about venture capital fund. This is another instrument that is there, venture debt, which is these are huge amounts of money that are available to you as debt. Again, the decision when to take a debt, when to take equity is a professional decision. So you need to take qualified decisions, and probably seeking the help of finance professionals will be really helpful because they give you insights into what is the right type of instrument that is required depending on the stage of the business and the growth prospects. So they normally come in at a growth stage, and the purpose is there for working capital. I am not sure how many people are aware of the different needs of company. By working capital, what we mean is working capital is to meet day-to-day running expenses, your monthly expenses. It could be your rent, it could be your fuel, it could be your salary, sort of thing. It is not investments. Investments in plant and machinery, investments in technology. These are all called as capital expenditure. But working capital expenditure is something that will go out month and month. And there is no guarantee for anything like that. So there are a lot of players, thankfully now, to fund us for working capital. Earlier it was banks who used to do it, but again they used to ask for customer list, their payment criteria. But if you are a startup, it's all in future. There is no retro debit. So there are some people who are going to come in this space, and there are more in that arena too. So that puts a complete overview about the different instruments that we have at our disposal, the different stages of the company, when to take money and what instrument to use, and who are the different players that are available. So in the short time, I assume that this overview would give you at least that idea of the different avenues that are available and also helps you as a checklist in terms of what you need to be prepared for before approaching these different avenues. But again, if you have to look from the investor point of view, because that's very important. Normally, if you only think from the entrepreneur side of it, we want money. But why will anyone invest in us? So you need to think from their point of view. So ideally, any investor is looking for these sort of a thing. And I will put first proprietary intellectual property, which Madam is an authority. So this is because we are talking about startups, because primarily startups is based on innovation. Your idea, be it a product or service, should have a large market size. That is very important. The third thing, management team should be large with experience. Because if there is only one man running the business, what if something happens to it? The entire money goes into the loss. So any investor would look into a team and they would understand the expertise of different people. What are the different people trying to bring to the table? And they would also look at how long will they be in this company. That's very important because all the investors in this ecosystem are investing not only on your idea, but more importantly on the person who is driving the idea or persons who are driving this idea. So this is a very, very important attribute. And then a scalable business model. A lot of people come to us and say that, okay, I want to get into a laundry business. Okay, fine. Who will be your clients? My hostel, become hostel. There are a lot of people doing this. Students are facing a lot of problems in washing. So what you will do? I'll do pickup. I will do everything and give them. This is my innovative business idea. Okay, how many students you can serve? 500. Okay, how? What will you do if this 500 becomes 50,000 or 5 lakhs? There is a question mark. So it has to be scalable because anyone who is investing in startups, he is not looking at a 10% or a 15% return. He is looking at a 300%, 500%, 1000% return. So where does that return come? It comes only in scaling and also wealth maximization. Even though you see what is Swiggy, Zomato, and what is the valuation? Are they making profits? They're not making profits. They're bleeding. But their valuation is high. Why? Because they have built a platform through which they are engaging with customers. And through the customer engagement process, they are not just delivering food, but they are identifying a lot of consumer behavior and winning the confidence of the customers and also having that important data with them through which they can sell or push it. Today, if you open Swiggy, you'll probably see a credit card ad. Apply for a credit card. And that ad, they probably get more conversions than putting in a paper ad. So they know how to make revenue besides their original business idea, and that will keep evolving day by day. So the revenue opportunities exist in future, but they are building all the core things now. At least that's what they are presenting it to the investors, and that's how the valuation of the company is going up, even though their profits they are not in cash profits. So scalability is very important, and ability to exit within 5 years. Any investor these days is looking for when will I make my money? I don't want to be invested forever. I want to invest now, probably. Will my money be back in 2 years, 3 years? 5 years is probably a high time, depending on the money they invest. So, you need to provide an exit plan, which is if you are preparing a business plan, you need to say that, okay, you put in money now, but at the end of 5 years, my company will make this much profit, and my wealth will be so much, and your wealth will be so much. So, you need to give him that story. That's what investor is looking at. And then finally, what he's looking at is the current valuation, gives opportunity for him for a good return. Like I was giving an example earlier, 5% for 5 crore. People come and pitch us. If I'm investing 5 crores for 5% for a company with nothing now, when this 5 crores will become 50 crores, and how will it become? So this is something that even though we tell them, maybe it's difficult for them to grasp because they're getting carried away with the successes that are coming, that are catching the headlines. But there are a lot of opportunities that are happening in the startup arena which are never published. And so are the failure cases of angel investors and VCs. Not probably 5%, 10% of the money that are invested by the VCs are successful. All others are not successful. So there's a huge risk involved. So once you start thinking from the investor point of view, what is it that they are looking at? It really helps you to really build your businesses if you are looking for outside money.
Sir, what is the desired valuation of the last statement? Means higher valuation is better for a higher return or lower valuation is better?
Again, the valuation is a different phenomenon, sir, because these days the companies, as I told you, are not valued for their intrinsic value, but they're also valued for a lot of other parameters. So, obviously, normally people would look at the profitability as a benchmark. How much PE ratio on EPS that the company would be running, and what is the industry multiple, and then try to make a comparison. Like for instance, if someone is starting a restaurant business, so if I have to invest now, I will get this much return. But if I invest in normally buying a restaurant straight away, I am getting this much return. So what is my way back to build this set of business? So instead of that, investing now is giving me good returns, so they'll get into it. But for startups, as I told you, it's crazy to even think about Zomato and all this, even for the matter Adani valuations, right? The valuation parameters have changed dramatically. So it is better to be grounded. The benchmark would be depending on the idea that we have. You look at the recent companies that are there, and if there is an acquisition, then you pick up that as a benchmark valuation and see how far are you from that company, and then fix up that.
As you rightly said, many times the headline says 5% stake for 5 crores. But what is the valuation they don't talk also.
What is the original share value and all that they don't talk. And again, you see, it's all for the public consumption. The devil is in the details. So once someone really goes into the different sort of thing, even the investment which they commit will not come at one go. It will come based on milestones. So they commit to this term sheet. The term sheet is the details are there. They say I'll commit to 50 crores investment, but they put about 5 milestones. Now they probably will give 50,000 or 5 lakhs. And they say if you complete this and this task by such and such time, then my next type of investment.
But as a thumb rule, what is the higher valuation is better or lower valuation is better to get a higher return?
Depending on the confidence of the product and service. Okay. If you my mantra would be if you are really confident about the idea, you never dilute it until the stage comes where the person who is bringing in money is really going to add a lot of value to you besides money. But if you seeing a lot of risks and if you are unable to manage sort of a thing, that's when you look for outside investment. And that defines to a large extent the valuation. So there is no fixed thumb rule sort of a thing, what is high, what is low. It also depends on the market timing, which is very important. These days there is a lot of interest in some sectors like tech, AI sort of thing. And that might suddenly change away. What valuation is today, probably the next 6 months, if there is an appetite for a new thing, this will completely go down. This has got nothing to do with the idea per se.
But as an investor, how do you measure it? How do you qualify the last step?
So my sense is, if you look from an investor point of view, you need to make the investor need to find it attractive over other instruments, right? So anything that is giving an investor, I would say, probably 100% return in say 2 to 3 years of time is a good investment for people at the angel side. But if you are looking at a VC side, they probably have a long waiting time of 3 to 5 years, and they are not looking anything less than 10x or 20x. So the potential has to be there to give that much of return to the investor. Okay.
Is a crowdfunding investment? Many investors involved in crowdfunding.
It's just demand and supply. You go with a quote, with an acceptance, fine, based on certain calculations. But again, otherwise you revise it. Yes, yeah.
Vizag.
I live in Vizag.
That's a great thing. So, are there any competitions? Vizag?
No, we are not doing this as a business. We are not doing this business. And yeah, we really want more and more people to do. There are definitely a lot of investments happening at an individual level and probably at a family office level, but not as something structured from Vizag that we are aware of. Ravi probably knows it better.
Because Andhra Angels and Vizag Angels are there, but nothing is they're gone.
Sorry.
Yeah. They're not into maintaining on the pure
invest.
yeah, but don't find them. They don't talk to people. They're not visible.
There may be a lot of people, but again,
Yeah, there are ton of sort of know without not very formal.
And we found as well.
Yeah, we found a certain bit not Vizag Angels. Vizag Angels, I think.
honestly, we have more visibility because most of the people are in Vizag. That's it. If we were in Hyderabad, then we would not take much pains to come down to Vizag and visit all this because there are a lot of companies in Hyderabad itself. So our team, most of the team members are in Vizag, so that the proximity really helps.
The five of us are really visible and go everywhere. Peter is in US, but
Opinion on the document you're talking about neurodivergent. So, neurodivergent.
this is some right.
So much so, you can set up a trial. There are technology people, Ravi, and people